In approximately 6 hours, Asian markets open. And what happens tonight could determine the direction of global markets for the next 3 months. This is not speculation. This is positioning. Right now, two completely opposite realities are priced into the same market. On one side, you have institutions betting that the worst is over. They see stabilization, they see opportunity, they're buying. On the other side, you have traders who see the exact same data and are preparing for a breakdown. They see fragility, they see denial, they're hedging. Both cannot be right. One side is about to get crushed. And tonight's session in Shanghai, Tokyo, and Hong Kong will likely expose which side miscalculated. By the time you finish this video, you'll understand exactly what signals to watch. But more importantly, you'll understand why this specific session matters more than the last 50 combined. Let me walk you through what just happened. Last Friday, the S&P 500 closed at 5,842. That's less than 2% from all-time highs. On the surface, everything looks fine, stable, almost boring. But underneath that number, something strange is happening. The volatility index, the VIX, closed at 16. That's historically low. That's complacency territory. Yet bond yields are sitting at 4.7% on the 10-year. Let me be clear. Low volatility and high yields do not normally exist together. One of them is lying. Either the stock market is ignoring a real risk, or the bond market is overpricing a threat that isn't coming. This contradiction has been building for weeks, and every contradiction in markets eventually resolves. The question is how and when. Here's the context most people are missing. Last Wednesday, the Federal Reserve held rates steady at 4.25%. No surprise there. But in the statement, they removed one word, one single word. They deleted progress when describing inflation. That word had been in every statement for 7 months. Its removal was not an accident. Markets noticed, briefly, then forgot. The 10-year yield spiked 12 basis points that afternoon. By Friday, the move had been mostly erased. It looked like a non-event, but here's what didn't get erased: the options market. Put volume on the SPY hit the highest level since October. Someone or multiple someones paid real money to protect against downside. Not small money, institutional scale. They didn't do that because everything is fine. But here's where it stops making sense. If big players are hedging, why isn't the VIX higher? If there's real fear, why is implied volatility so suppressed? The answer is mechanical. And it's the part most people miss. Volatility sellers have been aggressively shorting VIX futures. They've been collecting premium for months. It's been profitable, extremely profitable. But that trade only works if nothing breaks. The moment something breaks, those positions unwind violently. It's a spring being compressed. The longer it stays compressed, the more violent the release. Tonight's Asian session is the first real stress test since that Fed statement. And there's a reason it matters more than the US session that just closed. Asia trades first. This is obvious, but the implications are not. When US markets close on Friday, there's a gap. No trading for 2 days. Then Asia opens Sunday night, US time. Any news, any shift in sentiment, any repositioning that happens over the weekend. Asia absorbs it first. This makes Sunday night sessions extremely revealing. They show you what global capital actually thinks before New York gets a vote. Right now, 3 things are converging in Asia. First, China. The People's Bank of China cut the reserve requirement ratio last Thursday. They're injecting liquidity, aggressively. On the surface, that's bullish for Chinese equities. But here's the problem. They did the same thing in September, and again in November. Each time, the market rallied for 48 hours. Then it sold off harder than before. The pattern is clear. Stimulus is not translating into sustained buying. Something is absorbing the liquidity before it reaches equities. That something is capital outflow. Money is leaving China faster than the PBOC can print it. This is not speculation. The yuan has fallen 4.2% against the dollar since November, despite 3 separate intervention attempts. The bond between Hong Kong and Shanghai is showing stress. The premium on offshore yuan has widened to levels not seen since 2022. Tonight, if Chinese markets fail to hold their opening gains, it confirms the pattern. It tells you the liquidity injections are not working. And if China can't stabilize, the contagion risk is real. Second, Japan. The Bank of Japan is meeting this week. Markets are pricing in a 34% chance of another rate hike. That's not high, but it's not zero. Here's why it matters. Japanese investors own roughly $1.1 trillion in U.S. assets. Treasury bonds, corporate debt, equities. If the BOJ signals tighter policy, the yen strengthens. When the yen strengthens, Japanese institutions face a choice. Keep holding U.S. assets that are now worth less in yen terms, or sell. This is not theoretical. In August 2024, a surprise BOJ move triggered a 2,000-point drop in the Dow in one day. Most people forgot. Markets didn't. Tonight, any hint of hawkishness from Japan could trigger the same unwind. Third, Hong Kong. The Hang Seng has been the canary in the coal mine for global risk appetite. It's down 11% year to date. It's trading at 8.9 times earnings. That's crisis-level valuation. Either Hong Kong is screaming a warning that global markets are ignoring, or Hong Kong is a buy of a lifetime. There's no middle ground at these levels. Tonight's session will tell us which narrative has momentum. So here's the situation. In roughly 6 hours, 3 of the world's largest markets open simultaneously. Each one carries a specific risk. China, liquidity failure. Japan, carry trade unwind. Hong Kong, contagion confirmation. If all 3 show weakness tonight, it's not a coincidence. It's correlation. And correlation in a leveraged system is how crashes start. But if all 3 stabilize, then the narrative flips entirely. By the time U.S. futures open Sunday evening, one of these realities will be established. You won't get to choose after the fact. Let me walk through the bearish scenario first, not because I believe it more, because you need to understand what it looks like if it happens. Here's how the bearish case unfolds. Shanghai opens down 0.5%, not dramatic, just weak. The PBOC's liquidity injection fails to generate buying interest. Volume is thin. Bids are pulled. By the second hour, the decline accelerates to 1.2%. State funds step in to defend the 3,200 level on the CSI 300. They succeed temporarily, but the defense is obvious. It's artificial. International traders see it. They don't trust it. Meanwhile, in Tokyo, the Nikkei gaps down on yen strength. The currency moved overnight. Someone knows something. Rumors circulate about the BOJ meeting. Nothing confirmed, but the reaction is real. Japanese banks start selling U.S. futures to hedge their exposure. This pressure bleeds into Hong Kong. The Hang Seng, already fragile, breaks below its January low. The break triggers stop losses. Algorithmic selling kicks in. By 3 a.m. Eastern Time, U.S. futures are down 1.4%. The VIX, which closed at 16, is now pricing at 24. That's a 50% overnight move in implied volatility. For anyone short volatility, it's a margin call. Forced liquidations begin. The selling feeds on itself. By the time U.S. markets open Monday morning, the damage is already done. The gap down is 2.3%. Buyers who were waiting for a dip get scared. They don't buy, they wait. And the wait creates more selling. This is the bearish scenario. It doesn't require a black swan. It doesn't require news. It just requires tonight's session to confirm what the bond market has been whispering for weeks. That risk is mispriced. Now let me walk through the bullish scenario. Same starting conditions, different outcome. Here's how the bullish case unfolds. Shanghai opens flat. No drama, no panic. The PBOC's liquidity injection finds traction this time. Property stocks, which have been crushed, show signs of life. Volume picks up in the second hour, not euphoric, just steady. International traders notice the change in character. Some who were short start covering. The short covering creates a small rally. The CSI 300 closes up 0.8%. Not explosive, but constructive. Meanwhile, in Tokyo, the BOJ stays quiet. No leaks, no rumors. The yen stabilizes against the dollar. Japanese institutions, who were preparing to hedge, stand down. They don't need to sell U.S. assets tonight. The pressure that everyone feared doesn't materialize. Hong Kong follows the lead. The Hang Seng opens slightly higher on spillover optimism from Shanghai. It tests the January low. It holds. The hold becomes a bounce. By 3 a.m. Eastern Time, U.S. futures are up 0.6%, not dramatic, but the tone has shifted. The VIX, which closed at 16, drops to 14.5. Volatility sellers breathe easy. Their positions are safe for another week. By Monday morning, the narrative is clear. Asia shrugged off concerns, risk appetite intact. Buyers who were waiting for a dip feel confident. They buy, and the buying creates more buying. This is the bullish scenario. It doesn't require good news, it just requires the absence of bad news. In a market this stretched, sometimes that's enough. But here's the variable that could flip everything. Neither scenario accounts for what's happening in the Middle East. Oil closed Friday at $78.40. That's near the top of its 3-month range. But over the weekend, reports emerged of increased military activity near the Strait of Hormuz. Nothing confirmed. Just chatter. Here's why this matters. Roughly 20% of the world's oil passes through that strait every day. Any disruption, even a perceived threat, spikes crude prices instantly, and crude prices feed directly into inflation expectations. If oil gaps up tonight on geopolitical risk, it changes everything. The Fed's pause suddenly looks premature. The bond market, vindicated. The stock market, exposed. This is the variable that neither bulls nor bears have priced in. It's the unknown unknown. And it reminds us that markets don't move only on economics. They move on events. Events that happen on weekends, events that happen while most traders are sleeping. Tonight's Asian session is the first opportunity for this risk to be priced. If oil opens above $80, watch the correlations. Gold will likely spike. Yen will strengthen as a safe haven. U.S. futures will weaken. The entire bullish scenario I just described evaporates. This is why tonight matters. It's not just about Asia. It's about what Asia reveals about the world's willingness to hold risk. Let me connect everything. We started with a contradiction. Low volatility, high yields, something has to give. We identified 3 risk centers in Asia: China's liquidity failure, Japan's carry trade, Hong Kong's fragility. We walked through 2 scenarios, one where correlation confirms the bearish case, one where stability confirms the bullish case. And then we introduced a wild card, geopolitical risk that neither scenario accounts for. Here's what this all means. Tonight is not about predicting the future, it's about watching the present very carefully. The signals that matter are specific. First signal, CSI 300 reaction to the open. If it gaps down and fails to recover within the first hour, that's bearish. If it gaps down and immediately finds buyers, that's bullish. The recovery matters more than the gap. Second signal, USD JPY. If the yen strengthens past 148, it tells you Japanese institutions are repositioning. That's bearish for US assets. If it holds above 150, the carry trade is intact. That's supportive. Third signal, Hang Seng's relationship to its January low. A break below confirms contagion. A hold and bounce suggests exhaustion of sellers. Fourth signal, oil. Any gap above $80 changes the calculus entirely. It reintroduces inflation fear into a market that thought it was done worrying about it. These are your 4 signals, not predictions, not opinions. Just the specific data points that will tell you whether tonight confirms or denies the current price structure. Here's the reality. By the time you wake up Monday morning, this will already be decided. The Asian session doesn't wait for your alarm clock. It doesn't care about your weekend plans. It prices information while most of the Western world is asleep. And that pricing becomes the opening print for US markets. If you trade, if you invest, if you have exposure to anything denominated in dollars. Tonight matters. Not because I'm telling you to panic, not because I'm telling you to sell, but because this is when information asymmetry is highest. The people who watch will know something the people who sleep will not. And in markets, that gap is where returns are made and lost. I want to be clear about something. I don't know what's going to happen tonight. No one does. Anyone who tells you they know is either lying or selling something. What I do know is this. The structure of the market right now is unstable. Low volatility plus high yields plus geopolitical risk plus leveraged positioning. That combination does not resolve quietly. It resolves suddenly, violently, without warning. Maybe that resolution happens tonight. Maybe it happens next month. But the conditions are in place. Your job is not to predict the timing. Your job is to understand the setup, to know what you own, to know why you own it, and to have a plan for both outcomes, not hope. A plan. Because hope is not a strategy. And markets don't care about your feelings. They care about positioning. So here's the question I'll leave you with. If you woke up Monday morning to a 3% gap down in futures, would you know what to do? Would you panic? Would you freeze? Would you buy? If you don't have an answer right now, you're not prepared. And tonight might be the night that preparation mattered. Watch the signals. Trust the process. And remember, the market doesn't reward prediction. It rewards preparation.